Looks that we are 85 currently online. So this is the last week of lectures on this specific course. On Thursday, we'll have a wrap up. I'll explain how the exam will be structured and organized, as I said earlier. So it will be organized online. I will explain how everything will be organized in practice, what type of questions will be asked, and then we'll have a feedback session. So that is for Thursday, and now it's Tuesday, and the last kind of a topic on this course, which is insurance companies. Insurance companies, which is a kind of similar, kind of different from the institutions that we have been talking so far. Very interesting, yet somewhat different kind of a by nature than banks, for example. So today we'll talk about the basics of insurance, the agency problems in insurance. Whenever you read about agency problems in economics or finance, so typically examples are given from insurance markets. So they are inherent in any insurance contract. Potential agency problems. We'll talk about something called Solvency II. And then the last subtopic will be pensions. And we'll take a look at one pension system which is close to where most of us live. So that is a Finnish pension system. So insurance companies, so non-life insurance business, you would say, is somewhat similar across different countries, but pension systems, what is unique feature of pension systems is that they are very different from one country to another, as we will see. By the end of today's lecture, we should be able to answer the questions such as what are the two insurance companies' main sources of cash flow? How do insurance companies manage agency problems? What is the Solvency II? What is unit-linked insurance? You might remember that is something that Mikko Aul was mentioning while he visited us. And then the last one is what is a system which is called pay-as-you-go as a pension system. This is the picture that you might recall from the very beginning of this course. Why we had this was to highlight first the significant size of financial sector, different financial institutions everywhere relative to the size of economy measured by GDP. That was one reason. So these institutions are controlling, managing significant assets. The second reason was to highlight the differences from, say, one country to another. Say US, in US, banks relative to the GDP have not historically been that sizable, while in Euro area and in UK, Japan, banks in terms of the balance sheets relative to GDP have been much larger. Additional feature related to today's topic is that insurance companies and pension funds, first, I just highlighted that if you look at Miskin and Ekin's book, which is the latest version, 657 pages, only 29 pages cover insurance and pension funds. Yet, these institutions are sizable and they play a very important role in financial markets. That's one kind of observation. The other observation that we can make from this picture is that in certain markets, such as in US, insurance companies and pension funds, they're pretty massive organizations. Insurance companies, if you compare this blue bar across different countries, it's somewhat similar size, so 50 to 100% relative to GDP. So there are not that big differences when we talk about insurance companies' sizes. While pension funds in US, okay, a bit dated number, but in 2014, pension funds were roughly the size of the GDP, while if you look at the euro area, it's not close to zero, but it's clearly less than 50% relative to the GDP. This is something that we will take a closer look later today. UK, sizable pension funds, Korea, close to a rounding error, close to zero. So when we talk about pension funds and pension savings, so countries are very different from each other. But in certain countries, obviously, they play, in terms of size, a major role. So the basics of insurance is, the basic is that insurance companies which are risk neutral, they offer a product, a service for their clients who are risk averse. So I'm willing to pay a risk premium, insurance premium, just in case that I will crash my car or my house will burn down, as the implication if my house burns down it's in my life, it's such money-wise, it's such a big kind of a risk that I'm willing to pay bigger amount of a premium than what would be kind of mathematically the fair price. Risk neutrally calculated. Insurance companies are risk neutral. So they target large number of clients, large number of different risks for which they offer these insurance contracts against the premium price. Premium is the label for what customers pay, like for a, call it a put option. Insurance companies accept, they underwrite this risk in return for a premium. Insurance companies have two main sources of cash. First, they get this premium, this underwriting income from customers. Customers pay immediately today the premium for the insurance that will be valid for, say, next year. And investment income, they collect the premiums today, and this money that they can invest, and they do invest further in financial markets. Typically, pension institutions who have a somewhat long investment horizon, they invest the majority of their portfolio in equities, in stock market, while non-life insurance companies typically invest more in fixed income securities. And the underwriting process from insurance companies' point of view, deciding which risks to take and what is the true price, what is the risk neutral price. So that is crucial. As Warren Buffett, the chairman, the founder of Berkshire Hathaway, in his annual shareholder letter in 2010, he's known for his appetite, kind of that he likes insurance companies as investment vehicles. So he explained that in his shareholder letter by writing that insurance companies receive premiums upfront and pay claims later, and this collect now, pay later leaves us. So that is for Berkshire Hathaway or the insurance companies that they own large sums, and which they call a float. So this is collect now, pay later, that provides a float, and this float Berkshire can invest further in financial markets. If premiums exceed total expenses and eventual losses, they register an underwriting profit, which adds to the investment income produced from the flow. So that is why Warren Buffett likes insurance companies. He also later on refers to the tightening competition in the US insurance markets, which has led to a situation where in many years the expenses have exceeded the premium. So companies have made loss in their core business, but yet kind of as insurance kind of the float, this has been investment, as long as the investment returns have been greater than these expense versus premiums. So insurance companies still have been able to generate accounting profits. This is an example from Finnish insurance markets. Two observations here. The first one is that this is the non-life insurance part. We'll talk about life insurance later. Now, for non-life insurance companies, the biggest premium-wise product has been fire and other damage to property products, insurances. Premiums written slightly above 1 billion per year. The second largest motor vehicle, motor liability. So these are the biggest risks that customers insure themselves against. That's the first observation. The second observation is, which I have highlighted with this red color, is the loss ratio. So it looks that the premiums minus the expenses have in all these non-life insurance categories been less than 100%. So insurance companies have been able to, on average, pay only 72% as expenses relative to premium expense that they were collected in 2020. So it looks that non-life insurance business in 2020 was on average pretty profitable business for Finnish insurance companies. This picture, which I received from Finance Finland, shows the development over the past 10 years or so. So the biggest market has been, the biggest product has been in all years and somewhat increasing in terms of the premiums, fire and damage to property. And motor vehicles have been the second biggest of a insurance product. Other accident and health has been growing steadily all 10 years, and it might be that one day it will be the biggest risk that customers hedge or insure themselves against. In terms of which companies are dominant, so OP, Local Tapiola, If, they are the three biggest ones, Fennia the fourth one. In terms of the market share, calculated as gross direct premiums written. So this is how much customers have paid in terms of premiums. So OP is the leading, was in 2020. Aktia is not on this list. And why is that? I took a closer look at what Aktia, as I recall that they used to be in this business, but I found it from their 2018 annual report explanation that they divested the rest of its holdings for some non-life insurance company. So they started selling. They used to be pretty active in non-life insurance business, but they have been in steps gradually selling this business. The last kind of 10% stake they sold in 2018, and explain it, I underlined it here, that Aktia Bank is now completely focused on carrying out the strategy, which focuses on asset management and financial solutions, while competitive non-life insurance and pension insurance products are offered through partners. So as an Aktia's client, you are being offered these products, but they are not made by Aktia itself, but Aktia provides these products, these insurance products, from their partners. So this is as we saw from Mikko's presentation, and we were able to hear him. So they have been focused on this wealth management, asset management for a couple of years already, and in a way got rid of this non-life insurance business. Any questions you might have, so please write that in the chat, or some other method, ask me somehow else. So basic of insurance. So this is from Miskin and Eaken's book from chapter 21, which is the insurance companies chapter. So first, there must be a relationship between the one who is being insured and beneficiary, and the beneficiary must be someone who would suffer if he or she had not taken the insurance. So insurance should not be used for gambling. So there must be some real risk. The customer must provide full and accurate information to the insurance company. In short, the customer is not to profit as a result of insurance coverage. If there will be a third party who compensates the insured customer for the loss, the insurance company's obligation, the payment is reduced. Insurance company must have a large number of insured so that the risk can be spread. So insurance companies have a diversified portfolio of different risks. The loss must be somehow measurable. The insurance company must be able to calculate, to quantify the risk. The loss, the amount of loss, and the insurance company must be able to somehow measure the probability of this loss to be able to calculate kind of the mathematical value of this insurance product. Agency problems. As I said, they are inherent in insurance contracts. Insurance company can never know all characteristics of the applicants, and they cannot observe all the actions which are taken by the customer who has bought the insurance. So they can't control them every day by basis. The adverse selection is that customers who apply for insurance policies are more likely to be those in need of coverage. So this is bad news for the insurance companies, as the customers on average the customers who apply for the insurance contract, insurance company ex ante expects that they are the ones who are more risky than the average client. The moral hazard is an implication that once customer has bought the insurance contract, they might change their behavior into more risky behavior. And then one other dimension is that agents who sell insurance company for a commission, it might be that they are not that concerned about the risk of the policy because they are not affected. It's insurance company which is affected. And like banks require collaterals and some other metrics to make sure that customer has an incentive to pay the loan back. So insurance companies have also developed practices to manage these agency problems. First one is screening. Insurance companies might ask us certain kind of a piece of information, could be medical evaluation, for example, and it could be that insurance companies use risk-based premium. So the riskier clients need to pay higher premium. This kind of you would say makes sense. It could be that insurance companies use something called restrictive provisions. They discourage policy holders taking actions that make insurance claims more likely. As an example, that kind of in case of suicide, the insurance company in the small print says that they don't pay the life insurance for the family members of the person who committed the suicide. Prevention of fraud, somewhat big kind of activity of insurance companies. So investigations before they pay, they find out kind of whether it happened that the customer kind of claims only the correct kind of a loss, not kind of exaggerating it. They might cancel the insurance if they find out that customer is kind of acting recklessly. In all insurance contracts, typically you find deductibles to reduce moral hazard. It is that it could be that there's a fixed amount that insured the customer has to cover before the claim is being paid out. So the customer also needs to take part in this payment. So there's some kind of a omavastuuosuus in Finnish that customer needs to pay, which leads to lower premiums because the loss participation reduces the incentive to increase risk of a claim. It could be that customer might be able to choose that on various levels of deductibles, the more customer is willing to accept as deductible, so kind of the smaller is the premium. And co-insurance, it could be that the insurance company only covers kind of certain proportion of the loss, say 80% of the medical bill. So customer needs to kind of cover the remaining 20%. So these are in standard insurance contracts. Many of these, and the background is that insurance company is concerned about adverse selection and moral hazard. So that was non-life insurance business, which I said is somewhat standard, or somewhat kind of a standard as a product offering in various markets, and in terms of size relative to the economy, non-life insurance companies they're large, and they're large, you could say, for the very simple reason that kind of a customers do have in the everyday life different risks, property risks, vehicles or car risk, and some other, could say, health risks, which customers who are risk averse are willing to buy a put option, call it a insurance contract, and pay a premium for that. Life and pension market is a bit different. So life insurance, what is the risk of a life insurance behind the life insurance contracts? So plain and simple, it could be that you die too young or you die too late. By dying too late means that in other words is that you live longer, and it might be that you run out of your retirement assets. So to be prepared to live after you stop working and you retire, so you should start saving for these pension years. Of course, you could say that what kind of a risk is that? Everybody, or most of the people, would like to live as long as possible, and obviously that is fine, but money-wise, there is a risk. As once you stop working and getting a salary, you must have some means to live with, and you should be prepared for that. And this is where countries are very different from each other. We have very different pension systems in Finland than in Sweden, than in US, than in Spain, than in Germany, and so on, which makes this very interesting. The other thing what makes this highly interesting is that when talking about pension assets, we are talking about huge amounts of money. Okay, Solvency II deals with both non-life insurance companies and life insurance companies. And this was a big thing when it was implemented in 2016. The first solvency regulation was adopted in 1970s. And the idea was to harmonize the regulations for insurance companies in European Union. And it's part of the Capital Markets Union Action Plan. Capital Markets Union was the topic that we were discussing on the early part of this course. Essentially, it sets new set of capital requirements, valuation techniques, and governance and reporting standards. But these capital requirements is, I would say, the biggest thing in Solvency II. And it is a risk-based capital regime, similar to the concept of Basel III for banking industry. And you might remember we were discussing about the Basel III and how the capital adequacy is calculated for banks. Solvency II is the same for insurance companies. As with banks, insurance companies can use either internally developed models, IRBA models we were discussing for banks, or standard models produced by the regulators to work out their capital requirements. So this is the same setting for capital requirements tailored for insurance business, insurance companies. than what we learned for banks as Basel III was about. Different than banks, kind of insurance companies have a transition period of 16 years to fully implement Solvency II valuation requirements. So they do this in steps, but the transition period is very long. It's 16 years. So they do not need to kind of fulfill these requirements immediately, but kind of they can gradually kind of do it in 16 years' time. The biggest impact expected in the life insurance sector was a shift away from insurers offering long-term investment guarantees, which carry heavy capital requirements under Solvency II. So this was the biggest change relative to Solvency I. And what is this about? Especially until 2016, majority of the products, of the life insurance products, were of a type that the insurance company promised a fixed, say guaranteed a fixed return for the savings, say 3% or 4%, or as I was at the board of a company called Suomi Mutual. So it was a mutually owned life insurance company. The only product that they offered for their clients, the company was founded in, if you think of a company name is Suomi, so like Finland. So it's only possible because it was founded in 1890. So it was a old company, kind of has a long history of operations. When I joined the board, the company's asset, the balance sheet size, the assets were 7 billion, so it was a somewhat sizable of a company. The product that they offered for their clients was that essentially they guaranteed that for the savings that customers had saved under life insurance contracts yielded fixed 4.5% return. So 4.5% return, no matter what the interest rates were, no matter how the stock market was doing, no matter what the inflation was doing, it was a guaranteed 4.5% return. What the Solvency II regulation implied was that for a company to be able to guarantee these, in some cases, relatively high nominal returns, especially in the environment where the interest rates, which used to be when this 4.5% promise was made, interest rates were on the level of 5 to 6%. So then it was thought that the company can easily kind of provide this 4.5% return by investing its kind of asset, the balance sheet in fixed income plus something in equity markets and real estate and so on. Now, as the nominal interest rates have gone down year after year, and have been close to zero for several years already, so the Solvency II regulation implied that the insurance company must have relatively high equity capital, kind of a very strong balance sheet, relatively high equity ratio, to make it sure that companies are able to match these liabilities. And this led to a situation where life insurance companies started steering the customers away from these, especially the new customers, away from these guaranteed products, which carried very heavy capital requirements, to something new, something called unit-linked products. Altogether, kind of as it was said that the Solvency II with 2,716 pages, it was thicker than the Bible and more complex than tax law. So it was not an easy kind of a simple regulation, and it has some fans in terms of harmonization, but some critique also was raised, as kind of some people were claiming that it's an overly complex piece of regulation. Like it or not, that is something that kind of has been adopted. Yet that was adopted in 2016, but this is from last year's September, as European Union kind of published a change as the title says, 90 billion capital boost. So what is this about? So essentially what this is about is that as nominal interest rates are so low, and insurance companies have found out that even though there is this 16 kind of years transition period, the Solvency II regulation is pretty tough. It could be that the insurance companies can live with this, but essentially it limits insurance companies' ability to take risks. And you might remember kind of this capital markets union, the whole idea is that European financial markets would be more tolerant for risk-taking. It was found out that this Solvency II, which has its merits in terms of the riskiness of insurance kind of at the markets, similar to what we learned from the US market when the financial crisis hit. So some big insurance companies were also, there was a need to bail out some largest insurance companies in the US. So in a way, kind of taxpayers did not only save banks, but they also saved some insurance companies. And Solvency II's kind of the goal was to prevent something happening that happened in 2007-8. Okay, everything good so far. Now it was found out that this Solvency II became too restrictive for insurance companies to be able to take risks. So now kind of one step was taken back, as I've underlined, is a temporary reduction in insurers' capital requirements. So the idea was that, okay, now we have gone too far, let's take one step back and kind of lighten the capital requirement or lower the capital requirements a bit, so that insurance companies would have this 90 billion capital boost. So they would be capital freed for risk taking. That is what happened. It was a temporary. Is it good regulation or not? Kind of might be that kind of a you understand insurance companies complaining that, okay, the regulation comes back and forth, but this is what has been decided. Picture from Mikko Olp's slides. Aktia's total operating income in the third quarter last year was 67 million, 23 million from net interest income, 33 from commission income, and 9.7 million from life insurance. So life insurance is not the biggest business of Aktia, but relatively kind of a sizable kind of amount of money, and it has been growing. So it is important part of Aktia's offering, life insurance business. Aktia's interim report refers to Solvency II as well. They say that Aktia Life Insurance Company applies standardized formula for this solvency capital requirement. So Aktia accepts or adopts kind of just a standard formula the regulator has developed. Mikko mentioned this unit link, and this one section from the interim report highlights that the life insurance company's technical provisions increased to 1.5 billion. Unit linked make 1 billion out of this. So biggest life insurance product that Aktia is offering is unit linked life insurance products. Interest related technical provisions. So this is the remaining, this is kind of the fixed guaranteed return. That is something that insurance companies are typically not offering currently for new customers. The old customers who have made their contracts, kind of started their contracts on savings kind of many years ago, of course, they can continue with the product. But for new customers, typically insurance companies and like Aktia, they offer the unit-linked products, which we can see from the whole market. Unit-linked makes the biggest proportion of life insurance premiums year after year. One implication that this Solvency II had in the operations of markets, plus the change in the market environment, has been that, as this says, this is a story about Generali, which sold the German life business for 1 billion, Italy's biggest insurance company. The story goes kind of, the beef is here. The sale is the latest in the string of deals that have seen big insurance companies, including AXA, Prudential, and Standard Life, cut their exposure to traditional life insurance business. So they are selling their traditional life insurance business, which offer investment guarantees to customers. So this is the core. In traditional life insurance business, life insurance companies promise this fix, as in Suomi Mutual offered this 4.5% fix, no matter what the market conditions are. So these have become so capital requirement heavy that insurance companies have been trying to get rid of these. They are capital intensive and difficult to service when the interest rates are low. In 2015, Generali turned its focus to capital light products such as unit link, protection, and health. So Generali has made the same move as Aktia has done a few years ago as well. What happened for Suomi Mutual, which I said I was at the board, we did something that is pretty unique. It's a company that was founded in 1890. We decided in 2017, so 5 years ago now, 4.5 years ago now, to close the business. We found out it was more than 100 years old company, as the interest environment has been as it has been, and the regulation has become as tough as it has become because of via the Solvency II regulation. So we recognize that as a mutual company has some strengths. So it's owned by its customers, but it has some weaknesses as well. And one major weakness is that mutually owned companies cannot raise new capital. So to be able to take risks beyond the Solvency II capital requirements, we should have collected new equity from our owners, which is from our customers. So we thought that would be kind of a close to impossible thing to do. The other thing was that as we did not have the option to offer unit-linked products for our clients, but the only product that we had was this guaranteed product. So we recognized that it's better for our clients that we sell our, you would say, our customer base to other operating companies, and certain chunk of this business we sold to Mandatum, and the other part we sold to OP. And our customers now, as OP's customers, they have the option to continue as customers of this guaranteed 4.5% return, or they can choose to change their position into unit-link kind of product owners. So they have options. At Suomi Mutual, we were not able to offer any other option than this standard 4.5% guaranteed return. So how does unit-linked product actually? Okay, good, very good question. The next one is about unit-linked insurance. It is a combination of insurance and an investment vehicle. So essentially, unit-linked products, you could think of that it's a savings vehicle. So you choose as a customer into which type of mutual funds your savings are invested. But unlike in a direct mutual fund savings, when I go to Nordea or I go to Aktia and I said, okay, I have seen that Aktia's mutual funds have been performing pretty well in Morningstar ratings. So I do choose to one or two of these mutual funds and I start saving in these mutual funds. I can sell them any day, I can buy more. In unit-linked products, everything is done under this insurance, this unit-linked kind of umbrella. And under this unit-linked umbrella, I can switch from one fund to another, and there are no tax consequences. There are no tax consequences for me as a client before I start taking the money out from this contract. Unlike if I buy Aktia's one mutual fund, say European equity fund, and then it price doubles and I sell those mutual fund shares and transforms that money to, say, fixed income, I need to pay capital gains tax. But in life insurance, in unit-linked life insurance, there are no tax consequences before I start collecting the money kind of to my bank account. So I choose, I make the decision how much risk I'm willing to take. I personally, I prefer kind of investing in equity mutual funds. My wife prefers kind of bond or fixed income funds. Okay, it depends on customers' kind of willingness to take risks. So they are personalized investment mixes. Typically, why these are kind of somewhat popular is that, or relatively popular is that there are these tax incentives. So unit-linked insurance contracts are as such by structure pretty much the same, no matter in the US, UK, Europe, Asia. But of course, taxation varies, depends. Finnish taxation is different than Swedish taxation and so on. But and as taxation is such a big kind of driver for the attractiveness of these products, so in some markets, unit-linked products are kind of more kind of popular than in some other markets. Life insurance element gives the client control over who receives. So the contract kind of I have agreed that if I pass away kind of before I start collecting the money myself, so if I kind of die, so to whom this money will be paid. So that is defined in this contract. So that is life insurance, unit-linked insurance kind of life insurance kind of saving in mutual funds under this insurance contract umbrella. Are there any other questions, comments? Is it clear? Any reactions? Any? Are you awake? Is everything good? Yes, good. And not only kind of as the product per se is relatively simple, kind of what makes it somewhat complex to compare is that not only these, of course, the taxation rules vary from one country to another, but in one country, kind of the regulation, the tax regulation also changes over the years. So that is kind of you might kind of know somebody, or at least your parents know somebody who is retiring at the age of say 57. And I say, how can that be? In Finland, you should not be able to retire before your age of 62. The explanation could be that this person had started saving in a life insurance kind of it's a voluntary savings kind of a product, say in 80s, and then even in 90s, kind of the earliest kind of age that you were able to start collecting your savings was 55. Then gradually it has been increased. Nowadays it has been 62 for some time. Personally, I did my first contract in 15 years ago, and I start collecting these savings at the age of 60. So that is a voluntary kind of I did that decision kind of on my own some 15 years ago, but the tax regulation has changed over the years. Pension. This has to do with pensions, obviously saving for the years after you have finished working. Pension insurance kind of definition according to OECD is to pension insurance contracts specify pension plans contributions to an insurance undertaking in exchange for which the pension plan benefits will be paid when the member reaches a specified retirement age. And this is what I promised to you when we started. When we discuss about the pensions kind of systems, they are very different, kind of one country to another by many metrics. One very simple metric is how much pension assets are there relative to the size of the economy. And if you look at these numbers, this is from OECD's pension markets kind of statistics from last year. In Denmark, they have more than 200% relative to GDP in pension assets. Netherlands, pretty much the same. Iceland, Canada, USA, 160, 180%. Total OECD is somewhere around here, around 80%. Finland is here, roughly 80% as well. So this is 2020. So some countries have developed over the years a system where pensions have been saved worth more than the GDP. But then there are some countries which are relatively developed, I would say Japanese, Spanish system, Italian system, France, German system. They have had a pension system which is essentially pay as you go. So they have not saved for future pension payments. And this is a huge difference that we can observe between countries. And even big, such as wealthy countries such as Germany, has essentially not saved that much for the future payment savings. There's one outlier or kind of a unique kind of a country, which is a Norway, which is, where was Norway? Was here. Norway's here. So this is kind of, as we are all, we read every now and then about kind of a Norwegian oil fund, which is the size is, the latest was 1.4 trillion, so 1,400 billion US dollars. So relative to Norwegian size, so that is obviously kind of off the charts, you could say, that kind of clearly kind of many times the Norwegian GDP. But that is not, I guess, officially a pension fund. So that is an oil fund. So that is not, if it was here, it was obvious Norway would be somewhere around here on the top of this list. Oil specific kind of reserves. So this is where countries are very different from each other. Then about pension systems. The two main kind of structures in pension systems are the defined benefit pension systems and the defined contribution systems. This is good to know. And then there is this 401k. This is kind of also, I will explain. It is a section of tax code. Why is it good to know? It's such a kind of a everyday, kind of a common, kind of a in everyday term, kind of a terminology in the US. You can see that in US films, somebody said, okay, my 401k is kind of tanking, or I need to put something on my 401k. So it's worth knowing what that is about. It's about pension savings in the US. So defined benefit system is that the benefit is predefined. So, and who is kind of a guaranteeing that is the employer. So it is agreed that, say, one could be that once you retire, you get, say, 60% of your salary as a pension. So that is a defined benefit. Some pension systems can be fully funded, means that there are sufficient funds. Some are overfunded, not many. Some are underfunded. And this is, you might, once you watch a kind of American movies, sometimes there's a reference to companies being, the pension funds are underfunded. So that is a relatively big kind of a challenge for some American companies. They are underfunded. They have not collected enough to cover their promises that they have agreed to pay for their beneficiaries, their former employees who retire. So they have been promised that they will receive a defined benefit. Defined contribution is more capital light. It kind of essentially means that the benefit is not defined, but the contribution is defined. So it kind of implies that say employers pay say $1,000 every month, and depending on how these investments perform, if that is invested in kind of a well-performing mutual funds over the years, the pension will grow relatively sizable, while the other employee who invests mostly in kind of fixed income in the long run, kind of the savings will not grow that much. So the benefit is not defined, but the contribution is defined. The private pension plans, as I mentioned, companies do have their pension systems on. Obviously, there are some public pension plans as well, such as Social Security. And then this 401k. It is a US system. It's based on the US tax code. It's a retirement savings plan sponsored by an employer. So it lets workers save, and before this, the paycheck is is paid out, and taxes are being paid. Some employers can offer a matching, saying that okay, if you invest 1,000, we match that and invest in your pension system also $1,000 US. Employee, the worker decides where this money is invested. There was a statistics that I found that in 2016, 63% of these 401k assets were invested in mutual funds. So mostly these are invested in mutual funds. And of the mutual funds, the most popular option is target date funds, which we discussed when shadow banking and mutual funds were discussed. Massive system, already in 2016, 4.8 trillion, so 4.8 thousand billion on behalf of more than 52 million active participants. So this is a massive thing in the US. So has to do with voluntary a pension savings in the US. Some size are here. Sorry, there was a Juho asking if you are a buy and hold company. Juho has a very good question about the unit-linked insurance. Whether it is tax effective at the end of the day depends on first how active you are as an investor and how good moves you are able to make, how well you are able to utilize this tax benefit. You must compare that with the costs, and obviously costs are higher if you invest in a unit-linked contract, simply because you pay the management fee and other fees of a mutual fund plus some fee for this insurance, say umbrella for this the contract. So the costs are higher, and it's for the customer to decide how beneficial that is. As an answer for you, Juho, is that it used to be relatively attractive in Finland. That's why your parents, or it could be that your grandparents, talk so warmly about these unit-linked contracts or say life insurance contracts overall, as it used to be. When I did my first contract, I'm at the age of 55, but at the age of 40, the tax law allowed me for the payments that I did in the system. I was able to deduct these payments from my income taxes. So not from capital gains taxes, but from my income taxes. So it was somewhat favorable the higher your marginal tax rate was. Not only that, but I was able to deduct. There was a limit, of course, but the limit was somewhat high. In addition to that, I was able to deduct the payments that I made for my wife's pension savings system, which I also was able to deduct from my income taxes. Okay, that was changed. The age, as I said, I can start collecting if I like at the age of 60, so that is in 5 years' time. Nowadays, the age limit has been kind of increased. As far as I remember, it's 62 or 63. Plus, I can only deduct the payments from my capital gains, not from my income tax. So it has become much less tax attractive as it used to be. So that has led to kind of the product being not that kind of well taken by customers. So the market has been not growing as fast as it was. So it's not clear at all, Juho, and every customer must kind of think it from their own perspective. Some asked that were there some taxation changes in person in recent years? Getting more disadvantage. Yeah, maybe this might be something that kind of now, as I already mentioned, so these age limits have been changed and taxation has been changing kind of yes, taxation has been changing. Actually, it has been changing many times over the years that I remember, over the, say, 15, 20 years or so. And this, you might say, this happens in Finland, it happens every year, kind of a taxation kind of a system change. Yeah, Jonas asked kind of adding to Juho's question. Mandatory pension. This is something that you might see kind of Jonas's question. Highly relevant question, and depending if you're an entrepreneur, kind of how you can kind of deduct these in your taxation. It's kind of to summarize, you could say, is an opinion, or is it kind of it's verified by kind of by the facts. It's not only my personal opinion. You can see that in practice that this has become less of an attractive option, say unit-linked savings as a product. Then when the pension system is being discussed, that is actually the topic of that we are going to discuss next. So this is the big market. So previously we were discussing about the voluntary pension savings, unit link or guaranteed returns, but that is something that everybody can decide. I can decide on my own whether I start that, or do I kind of do it on my own and start investing on my bank account, or do I start saving for my retirement years by investing in mutual funds, or should I prepare my pension years by investing in direct shares, or should I prepare for my pension years kind of by buying some apartments and put them on rent? So that is the key question, but that is voluntary. But then there is one thing system which is not voluntary, and that is the Finnish pension system, which is a earnings-related pension insurance system. The idea is that it aims to make sure that you have income when you are old, have developed disability, or the wage earner in your family dies. So basically, kind of once you retire, you will have some income. It's statutory, so it's set up in law. So that is not voluntary, it's statutory, it's mandatory system. The Finnish pension system, as I already mentioned, so all systems are very different from one country to another. This is the Finnish version. It consists of defined benefit earnings related pension system, which is the biggest chunk of the market. So it is a pay-as-you-go system, and some pensions are financed according to the principle of partial funding, approximately 25%. So what this means is that I do not have been working since I was 20, 21, 22, so 35 years now. So I have had no other option than save in the saving in this pension system for 35 years, so that my employer has paid every month some proportion of my salary into this system. Into this system in the way that I have no way to influence how that money is being invested. So that is somebody else is taking care of this investment. If I happen to die before my, was it 63 years kind of is my will be my earliest age to retire. The latest is 68. So if I die within the next 8 years, so obviously I will get nothing of these savings. Not my family member, nobody. It will be saved in the system. So that is a mandatory system, and I have nothing to say how this money is being invested. And obviously, I don't need the money because the financial risk that I linked too long, so kind of the risk disappeared because I kind of passed away before retiring. So obviously, the risk is not there. I have been saving. Everybody has been saving who has been working, and currently we have saved roughly 240, 250, as we will see, billion worth of savings. So we have saved a lot, and this was a bit dated kind of picture here, as the investment market has been so good kind of after 2020. So currently Finnish kind of version here would be roughly 100%. Our Finnish GDP is a bit over 250 billion. So we are roughly kind of relative to the economy, we have saved 250 billion. But this is only 25%. This is a lot of money, but when we discount the future, because this is promises for the future, that the future pension, the people who are currently retired and the ones who will retire, they have been guaranteed. It's a defined benefit system. So if you calculate the present value of all these promises, you will end up to close to 800 billion. So the value of these promises in today's money is 800 billion, while it's only funded, the funds that we have saved is 250 plus minus something. So roughly 25% or 20%. So this is the biggest chunk of people belong to these earnings-related pensions. If your salary is 4,000, so you will get some 2,000 worth of kind of pension per month, and it is a defined benefit earnings-related pension. If you have earned nothing, the minimum everybody gets, this is in 2018's numbers, kind of the guarantee pays, everybody receives 750 euros per month. And this is a Finnish specific, but I find very interesting graph as it shows two things. The whole system was started in year 1962, so it's relatively new system. Then employers started saving into this system 5%. And this 5% now has increased to the level of, this was a couple of years ago, to the level of 24%. So you could say, and this is a tax-like kind of a cost for companies. So massive increase. Plus, what happened was that kind of employees were forced to put money into this system worth of 3%, and that has increased over the years to depending on how old you are, to the level of say 6+%. This money also I do not even see that money, because that is what the university who pays my salary, they take this 24%, plus they take this automatically before my net salary is being paid. So actually today, 15 this is my salary day, I earn my salary, the monthly salary, but was this system not in place, so I would get 24 plus 6%, so 30% more. Okay, but this is not that I can influence at all. It is being saved into the system. This is something that Jonas mentioned. So if you are an entrepreneur, you can decide yourself how much you save into the system. So entrepreneurs can decide themselves whether they invest in this system or whether they somehow prepare for the retirement by some other means. The question was that is it significant to have over this is just kind of a, while we compare with the GDP, we are comparing apples with oranges. Obviously that's to make that clear, but to compare different countries, so obviously American market is big, the country is bigger than say Finland or Germany, so to show kind of relative to the economy, kind of how the pension savings kind of amounts kind of are very different. So that is why these are divided by the GDP. Obviously, everything depends on of whether these are the systems are defined benefit or defined contribution, and what are the other parameters, kind of what is your retirement age in each country. So kind of GDP has not directly anything to do with that. While some countries have 10%, while others have 180, it is very simple. As in Germany, they have decided that they do not save for future pensions, more or less. While in Finland, we started that in 1960s. You could say, luckily, we started that system. We started in kind of very kind of minimalistically, only say 5%. But now, thanks to these savings, we have, okay, this is just to show that kind of annually, the pension insurance system is clearly the dominant market in terms of the size, while life and other personal insurance market is clearly less. Non-life insurance is also say worth the premium size 4 billion, while pension market has been around 16 billion. I will come back to this question kind of in a minute. Why this is so interesting, the system that we are living kind of in the system currently in Finland, is that over the years, the premium income has been pretty close to kind of the pensions paid every year, but the change happened a couple of years ago. And how the market is currently is that this illustrates kind of as a snapshot from 1 year. So this is 2020. So earnings related pension contribution, this is how much money was collected. This is from everybody who worked, and from there 24 plus 6% was saved into this system. That is called a pension contribution. That money was worth 22 billion. But the claims paid, so in other words, pensions paid, was already 29 billion. So now we are paying, the system is paying more money out than what is being collecting in as premiums. But luckily, we had in 2019, we had 218 billion in assets. Luckily, these assets have been able to generate returns, so increase in size, so that despite that more money was paid out in terms of the current pensions than was being saved in as collected premiums, so the pension assets grew to 224. And this is the picture that we had. Sorry, I can't see this kind of totally. So lecture 2. So this was to highlight the size of different financial institutions in Finland. Obviously, this is the biggest kind of one chunk of money. This is the private pension institutions, Elo, Ilmarinen, Varma, Veritas. The biggest was Ilmarinen. This was in June last year, managing 68 billion worth of different assets. This is the asset allocation. Close to half has been invested in equities, real estate, and all these kind of hedge funds and so on. You can see that Varma has invested in 16% hedge funds, while Ilmarinen only 6%. Okay, these are private companies. All private pension insurance companies totally they were managing 147 billion worth of assets. Then there is a local government pension fund called Keva, Kuntien eläkevakuutus, managing 68 billion, and state pension fund, Valtion eläkerahasto, 22. If you add all these 22, this makes 86 plus this, so we are very close to kind of a 200, and we were in June, thanks to the good performance, especially in the stock market, and the bond market did pretty well until last summer as well. So we have been able to grow the assets of pension institutions, despite the fact that we have been paying more money out and we are collecting money in. And this is something that kind of now we are having this 240 billion, which is very close to Finnish GDP. This is, to answer your question, Andre, why is it important? So it helps us when in the future, when the Finnish demographic kind of structure is somewhat challenging, kind of the big generations are retiring currently, and the birth rates have come down, you could say, dramatically. The latest number was something like kind of 1.4. So kind of there will be less employees who save into this system, and they will be kind of relative to the proportion of the people who are retired. People live longer, and the system needs to pay these pensions for tens of years according to the rules. So, but luckily we have saved something in this system. Had we not saved this 240, say, like in Germany, like in Spain, so all the pensions that are being paid today must be financed by the premiums that are being collected today. So that is why these systems which have not saved that much, like in Germany, like in Spain, like in Japan. So systems are systems, but for individuals, this is important for you guys to understand that, this is the system. And for you, Jonas, asking for entrepreneurs kind of a point of view, you just think of the future currently, what we know. It is a defined kind of benefit system, partially funded. Birth rates have kind of come down heavily over the past 20 years. That is a major challenge for the system. Interest rates are very low. That is a challenge for the system. So you might see that objectively, kind of there's a huge risk in future, kind of these defined benefits. So the pension levels will be lowered by some decisions. It could be that the earliest retirement age could be increased from 63 to 65, 68, 70 or so. Obviously, that will ease the burden in the system clearly. It could be that the pension level is being decreased, so that you will, especially you guys, once you retire you are so young, say in 50 years, so the pension that you will receive is much lower than what your parents receive relative to their salary. So that means that is an implication for everybody. Start saving yourself voluntarily. I'm not saying that how should you do it. You can kind of put your money on a bank account. You could buy direct shares. You can buy mutual funds. You can buy kind of investment, apartments, whatever. But start taking care of your future, kind of financial future on your own. Don't rely 100% on this system, which is something that your parents, many of them kind of got used to rely on this system. The system provides me some pension. Yeah, okay, they do earn some pension, but kind of is it enough? And is it as much as it expected? And that has been a disappointment for many, but still the pension levels are somewhat high in Finland. Will they be this high in the future? Most probably no. So that is for you to understand. If I was an entrepreneur, I would do this pension saving somehow else than putting my money on this system. I would put as little as here. The good part of this system is that if I have challenges in my kind of a self-control, if I have my money in the liquid form, so it easily happens that I use it for something. But the money that I have in this system, I can't touch. And that is something that many people do have challenges kind of with the self-discipline. If you have self-discipline system, this system is for you. But if you can do it kind of, if you have a self-discipline, you know what investing is about, you like it, you kind of enjoy it, kind of doing it, kind of, I encourage you to do it kind of on your own. On top of this system, this is something that you must do. Entrepreneurs can choose, but then you need to remember that you do need to somehow prepare, or it's better that you prepare somehow for your pension years. Wouldn't the pension be running out? Yeah, that is the challenge, because the population aging, people, we are living longer, which is kind of good news, but obviously the whole system, it's kind of money-wise, it is a challenge. So that is one reason, if you look at kind of, that is one reason why older people need to pay nowadays more, and people who are retired, they also need to pay these payments. So that is kind of, there have been these gradual improvements money-wise into the system, which means that people need to save more into the system, as we have recognized that, yes, people are living longer, and the system does not have kind of, we have not saved 100% relative to the current value of these promised benefits, but we only have saved 25% or so. There is this article in the reading list of Karl Hinrichs, which highlights kind of the recent pension reforms in Europe. I encourage you to take a look at that. That's kind of covers, kind of also has to do with aging population, has to do with kind of how the European pension market looks like currently, and what are the challenges. Any other questions, comments? Everything good? Thank you very much for today. We have one set to go, and that is on Thursday. And then I will explain kind of, we'll take a summary, wrap up, and then I will explain about the kind of the exam as I promised, and we'll have some feedback session. Cheers. See you on Thursday then. Bye.